Welcome back to This Week in Finance, in which we cover everything business, property, investing, and personal finance related, and make sure you drop one of these to beat that YouTube algorithm. Bank of England rejects lifting inflation target from 2%. Bailey signals more interest rate pain to come. Bailey said that it was absolutely critical that there would be no confusion about the target, even as the bank struggles to get near it, with inflation currently at 8.7%. Market expectations that rate setters will continue an aggressive series of hikes even if they threaten to drag the economy into recession. And traders are betting that it will hit 6.5% in the coming months. Bailey's remarks came during a conference in France where he acknowledged that the UK was facing a more severe inflation problem than other countries. Bailey defended the 2% target, saying it was low enough that consumers do not have to worry constantly about prices going up when making everyday economic decisions. There's certainly a concern because inflation is a high amount, but I think that the Bank of England aggressively hiking interest rates to, let's say, 6.5% is a concern, because what might happen is inflation could start to fall very rapidly. A potential inflation car crash coming on here as the Bank of England quickly then scrambles to try and balance interest rates in order to restore inflation to that 2% target. So in the time of high inflation, the pound has actually raced to a 15-month high. The pound is the best performing major currency against the dollar in 2023, up nearly 7%. And the pound is up nearly 25% since it crashed towards $1 free in the wake of the mini budget last autumn. Rampant wage growth in the UK piled pressure on the Bank of England to raise interest rates to tame inflation. It's important to note here that by raising interest rates, more foreign investors are going to the UK and going, we would like to actually save some money in the UK due to the higher interest rates, which is causing a demand on the pound, which is pushing up the value of the pound. This could be more of a short-term impact, and over the longer term, we may actually see this weaken against that of the dollar. Pull rates back down, this could lead to a level where obviously the pound is not as strong as it may seem. After a fall in GDP for May, the harsh reality is that the UK economy has barely grown for a year and a half. Recession has been held at bay so far, but pressures are building in several areas. Both construction and production fell in May. The Bank of England has spelled out the strain mortgage borrowers will come under in the next 2 years. Unemployment is now rising and vacancies for jobs is beginning to fall back too. Yet despite stagnant growth, inflation remains stubbornly high, with nominal wages still accelerating, albeit at a slower rate than price increases. Once rate rises are felt more widely and house prices fall further and employers cut their budgets for pay rises, sentiment could quickly unwind. As we are seeing rates increase, we're obviously seeing a contraction in the overall spending of the economy. A lot of businesses have entered fixed contracts. A lot of consumers have entered fixed payments on their mortgages, meaning they're fixed for 3, maybe 5 years and potentially at a lower interest rate. Therefore, whilst interest rates have increased quite significantly over the last 2 years, the key concern here is once these fixed periods end, I think inflation could rapidly fall back down. Jeremy Hunt's pension tampering can only make you poorer, in an article that's clearly not politically minded at all. It mentions here that the Chancellor says his bold new pension reforms will make you £1,000 a year better off in retirement. And what's more, they'll bolster Britain's businesses at the same times. The government's own analysis shows that once high fund management fees were taken into account, the average pension saver could actually be £1,300 worth off. Britain needs a homegrown business boom. The plan is simple. The country's biggest pension funds agree to invest 5% of their assets into British startups and private equity. Surely if this was a good idea, your pension fund manager would be doing this already. Private equity investments are notoriously risky, and Mr. Hunt's pension plan dumps all that risk on the saver. And it's a risk many can't afford to take with their retirement funds. What savers really need is a better system that allows them to take control of their pension, take interest and responsibility for it. I wonder how many of us could retire richer or earlier if we engage with our pensions in the 20s and 30s. I'm not a fan of the direction this article has taken. You are in complete control of your pensions if you choose to look at it. The sad reality is that many individuals are too overwhelmed by it. They're too scared of the idea of tampering with their pensions because they don't know what they're invested in. I at least know that my pension is invested in the S&P 500. It's at a low fee, and I'm betting on the US economy to win. You could see quite a boom, as mentioned, in smaller businesses that could potentially give higher growth. Now, in his situation, I can understand it because pensions have a lot of capital available and would be a a great source of money in order to push more growth into these businesses. However, the typical person that has a pension likely doesn't want this, tapering this by age and suggesting that the closer you are to retirement, the less you might have in private equity, although I fear that the concerns are here that there actually wouldn't be anywhere near as much money invested in small firms in private equity, hence the concern. Now on to trending tickers. Ocado stock had sank more than 3% in early trade as the M&S bosses professed they are unhappy with the pair's partnership. He felt there were more work to do as losses piled up at Ocado. The grocer said it had posted a £501 million loss this year, a £177 million increase from the year earlier. These losses mean Ocado will bring in around 40% less than originally projected in performance payments from M&S. The online trading group Plus 500 expects full-year revenue and adjusted profits to be in line with market expectations. This is despite lower volumes across the wider financial market. First half revenue grew 15% and earnings before interest, tax, depreciation and amortization, or EBITDA, soared 17% in that same time. The suggestion that lower volumes across the wider financial market implies to me that they're likely hiking fees, so it's probably not a sustainable growth pattern, but then you could argue they've got a very dominant business model that investors are likely to stick with the platform despite the high increases in price. Centrica signed an $8 billion deal agreement with US-based Delphin Midstream. The deal will see the owner of British Gas buy 1 million tonnes of liquefied natural gas a year for 15 years, to provide enough energy to heat 5% of UK homes for 15 years. While UK prices also tumbled as gas consumption remained well below seasonal norms since the start of June. UK liquid natural gas imports also slumped to their lowest level since summer of 2021. It does seem odd that some businesses are now looking to fix their energy prices, and we should probably keep our eyes open to this because they may suspect that energy prices are going to rise again in the winter, especially if obviously China sees a strong recovery in their economy and we see quite a cold winter snap. This could certainly add a lot of pressure to the prices here. Fashion retailer Sosandar confirms first year of profit. They've confirmed their first annual profit with pre-tax earnings coming at £2.2 million versus a £600,000 loss in the previous 12 months. The online women's fashion retailer sales momentum continues into the new year, with revenues up 10% on the previous year. Sosandar has attributed its strong start to the financial year to an increase in demand on their summer range and holiday clothing. UK pub chain Wetherspoon stock has ticked up a significant amount following a promising trading update in which investors cheered full-year profit forecasts. Positive numbers were supported by bank holidays earlier in the year and a partial pullback in energy costs. In May, the company had said that full-year profits would be towards the top end of market estimates. The level of debt is also £114 million lower than before the pandemic. A return to the payment of a dividend may still be a way off as finishing touches are made. I disagree with this. Wetherspoons is probably not in the best position to be paying a dividend. It makes more sense for the business to realistically reinvest back in operations. So the fact here that investors might be sitting here going behind Wetherspoons and going, oh wow, they could be paying a dividend soon, an environment of the economy where obviously interest rates are rising and they're still sitting on a hefty net debt position of £668 million, well, it wouldn't be too wise in my opinion for Wetherspoons to be making such a move, and it could be an interesting one to watch. Barratt Developments has warned of a slump in house builds as it said cost of living pressures and rising mortgage rates were impacting home buyer demand. Now, the company's average selling price fell to £343,000, almost a drop of 9%, and it said that there was due to a lower proportion of sales from London. The house building giant is forecasting its build completions to tumble as much as 23% over the next year, and total home completions fell 3.9% in the previous year. Notably, they are seeing a lower proportion of sales in London. This is the trend we've been watching the last 2 to 3 years as more people are working from home. Offices are now downsizing, like the HSBC is looking to move into the city. A lot of employees that work from home also want more space at home, so they're probably going to move away from London because they could commute in. Now, one to watch here would be the likes of Redrow. They said that they'd been moving out of London about 2 years ago now. Doc Martin shares are doing all right here. It said that trading since the start of the current financial year had been in line with expectations, and progress had been made rectifying the US warehousing fiasco that led to a series of profit warnings. As said, direct-to-consumer operations had seen seen very good growth both EMEA and Asia Pacific, with continued strength in retail as traffic recovers post-pandemic and good e-commerce growth. Wholesale revenues were lower year on year across all three regions. Sales in the Americas were also down compared to the recent year, although Doc Martens said that this was in line with expectations. Mentions here that it's taking actions to progress its DTC direct-to-consumer business in the Americas and expects to see a meaningful improvement in the second half. We've also got Burberry here that said that they reported a surge in sales as a reopening of the Chinese economy after lockdowns has delivered a strong recovery. Burberry had generated revenues of £589 million from £505 million in the previous year. Comparable store sales for the group, excluding mainland China, was up 11%. However, the Americas division was an outlier again, with the trend like we're seeing with Doc Martens falling 8%. We've made good progress across the quarter in delivering high teens comparable revenue growth led by the ongoing recovery in mainland China, said Burberry's CEO. In terms of my stock portfolio, we've actually seen some good performance over the last week in which shares are up by probably about £1,000. I'm going to be stopping deposits into my stock portfolio, but I will be expanding upon this in more detail coming up in the next few weeks. There is a good reason for it and it's very logical. I'm trying to conserve money at the moment and I'm making some big moves outside of the YouTube channel, so please keep that in mind. In terms of the actual portfolio performance itself, Boohoo is still down about 70%, but Games Workshop is doing very well. It's pushing up into £111, I believe, which is really dragging my portfolio performance up and helping me recover from some of the losses that I've seen through Boohoo. Then Sylvania Platinum, that was quite down last week, has actually seen quite a good recovery as well, although my position is very small. And we're also seeing the rising pound, which is pushing down my performance in some of the American stocks, as well as the American stocks had seen a little bit of a fall over time. So there could be some opportunities here in the likes of, let's say, Alphabet, perhaps to be getting some more, or to be keeping an eye on the US markets to be purchasing some more. Now, if you like this video, definitely click that subscribe button as it is much appreciated. And if you'd like to see more about the UK mortgage crisis, then click this video right here.